Good afternoon or good morning, depending on when you are, and welcome to our webinar on the recapitalization of European businesses post-COVID-19. As we know, many months of lockdown measures have had a severe impact on the global economy. The situation in Europe remains very difficult for businesses and households across the continent. But we now have the prospect of vaccines being gradually rolled out and the prospect later this year of a new normal beginning to emerge, hopefully towards the second half of the year or the end of the year. So we believe it is therefore time for Europe to start preparing for the long road towards economic recovery and the recapitalization of large and small corporates. As we all know, until now, extensive government support measures, debt issuance and bank lending have kept many EU businesses afloat. But the funding and debt alone really cannot be the only solution going forward. The latest quarantine measures will put even greater pressure on many businesses with strained or already depleted cash reserves. And many larger companies and SMEs will need to manage their increased leverage while also trying to invest in innovation and their long-term growth. So in this context, we at AFME believe that alternative types and sources of funding will be required to help mitigate the mounting debt burden. And Europe's capital market can indeed offer a number of efficient solutions in this regard. Today's session follows the publication last week of a report prepared by AFME and PwC, which examines the size of the corporate recapitalization program and potential solutions. We have been very encouraged by the response to the report and the debate it has triggered. The research has been widely reported in a number of outlets, and we have received many questions and comments, which we're very pleased with. The audience for today's webinar includes over 250 participants from across the EU institutions, as well as national governments, official sector bodies, business representatives, banks, investors, and other market participants. Given the scale of the looming recapitalization challenge for European corporates that are impacted by the pandemic, our members at AFME felt we should pursue four main objectives with this report we published. First, we wanted to quantify the problem, that is to provide a credible estimate of the equity shortfall, given the corporate leverage caused by the guaranteed loans, which were much needed and welcomed, of course. Our second aim in the report was to gather feedback from corporates and private investors on what exactly they are and aren't willing to issue or invest in, respectively. And we will talk more about that as we present the report. Thirdly, we wanted to explore short-term and medium-term solutions to the funding challenge. And this includes looking at a range of equity and hybrid instruments available in Europe and sharing best practices on the instruments that work well in different member states and how they can be scaled up at a European level. Our aim here was to promote dialogue between the private and public sectors on possible solutions and new types of instruments that could support companies. And we will talk more about that in this webinar. And finally, as the saying goes, we believe that a crisis should not be wasted, and we wanted to promote debate also on solutions that advance the capital markets union, that help to reduce reliance on bank loans, and that serve to further integrate the single market. Clearly, capital markets must be part of the solution, and we wanted to promote debate on how to best advance that. So in today's session, we will begin with a presentation of this report, and this will be followed by a panel discussion with very distinguished participants that I will introduce a bit later. I would like to mention to the audience that there is an opportunity to ask questions throughout the webinar. Please feel free to submit them in writing through the system. We will be picking them up as we go along. So please keep that in mind. And now let me introduce the two colleagues who will be presenting the main findings of the report before we have a panel discussion. We will start with Nick Forrest, UK economics leader at PwC, who will focus on explaining the shortfall estimate we put forward in the report, explaining the survey that we undertook and the data analysis. And then we will have my colleague Rick Watson, AFME's head of capital markets, talking to us about the recommendations and the solutions that we put forward in the report, including looking at equity and hybrid instruments. So let me now hand over to Nick, please, to take us through the main findings of the report, and then Rick. Over to you, Nick.
Thank you, Pablo, and good morning, everyone. My name is Nick Forrest, a leader of economics practice, and I've done a lot of our work on financial policy over recent years. If we move to the next slide, I'll take you through some of the analysis we did and some of the findings from the interviews that we did with corporate treasurers, with CIOs, and also investment banks. But firstly, the case for recapitalisation. So the context for this report is clear to all of us. COVID has been a huge, sudden, unprecedented impact. It's particularly stark economic impact through many sectors of the economy. And the sort of impact that actually corporates aren't really designed or set up to deal with. Corporates are flows of economic activity, flows of finance, and they're not stores of wealth. And hence that this crisis really has hit many businesses very hard. As Pablo said, capital markets have remained functioning and open during this crisis, unlike the GFC. So businesses have been supported well by public schemes and functioning capital markets. But we're in the middle of a second wave. We expect continuing economic damage, and some of the effects won't really be seen until spring, summer of 2021 through sort of balance sheets and as the losses percolate through the system. So we do think now is a unique situation. It's a unique chance to not use the existing or the normal tools available to banks, investors, and corporates, but actually look at other options. We also think there's the growing level of corporate debt across Europe and across the world. And that kind of means there's sort of two ways to go at this point in time. We can either add more and more debt to the system, and that involves reducing cash balances, increasing leverage, reducing balance sheet flexibility, reducing resilience. And if interest rates go up, the consequences of that. The other way is to recapitalise and put corporate balance sheets on a more stable footing with equity and hybrid capital that can enable the flexibility to innovate, invest, and grow. So this is the time and the opportunity to look at things a little bit differently, which is what this report did. If we go to the next slide. So we then looked at kind of the size of the problem. And I'll start on the equity side, which is the bottom two parts of this slide, and then move to the debt perspective. The European Commission looked at cash flow deficits of European corporates quite early on in the crisis in May time, and they estimated a 720 to 1.2 trillion cash flow deficit needed to be funded by equity across the corporate landscape. Interestingly, when we looked at this, we found that actually the growth assumptions adopted were quite pessimistic in the stress scenario, the 1.2 figure. So when we started this work at the end of the summer, we thought actually the need may be less. We've now seen the second wave. We've seen continuing economic challenges. So looking at the EC's second wave scenario, that brings us back towards the middle of this range. We've also seen figures from an Italian study that provided a figure of 117 billion euro for Italy. And also the Bank of England's done similar figures. 180 billion pounds sterling is the UK equivalent. So if you gross those figures up, they all come back to around about €1 trillion. So we do think that the need for equity refinancing is in that €1 trillion range. What's available, though? If we come on to the equity shortfall, there are many sources for meeting this need. There's existing private sector, so issuance of equity and hybrid instruments. We think that's worth at least 150 billion, probably about 300 over 2 years. And there's also lots of public schemes that have been announced by the EU, by the EIB, and those provide either direct targeting for SME financing support or just broader grants and loan support that still alleviate the need for this equity shortfall. In our best case, we still think there's a 450 billion equity shortfall, comparing that need to what we think is available over the next couple of years. And by point of comparison, just the new equity issuance in the last year was only 9.3% of that amount. There still is a big quantity of need. Question, of course, is debt the solution? Can we just rely on debt? It has been done previously. Worryingly, we think there's a growing amount of unsustainable debt across the EU, 324 billion at the top of that slide. And when we look at corporates in particular and look at the vulnerability of corporates, this is defined, the chart on the right here, by those corporates with an interest cover ratio of less than 1 for 3 years. So corporates in a vulnerable situation, driven by indebtedness. We see significant numbers of corporates are in those kind of categories. So the capacity there for additional debt is very low indeed. Move to the next slide. That's kind of the size of the problem. Now, what are the barriers? So we did speak to around 30 corporate treasurers, chief investment officers, and other financial market stakeholders. Think, well, why can't this be recapitalized? So I'll talk about the corporate's perspective and then the investor perspective. On the corporate side, the preference first was to cut costs and restructure, and that's the right thing to do. If a business is not the right structure anymore coming out of COVID due to structural changes rather than cyclical changes, then there does need to be a need to restructure the business and cut costs. Now that is an opportunity for the financial services industry through asset sales or refinancing to help that restructuring, and that's the first point of call. There was then concern about ceding control, and we heard this many times, particularly the sort of smaller or founder-owned businesses, that concern of giving up equity, giving up control of a business. There's an interesting statistic we came across that owners were willing to pay an estimated 8.8 percentage points more in interest costs for solutions that did not avoid diluting control. Then there's the question of valuations. There's always going to be a valuation and pricing mismatch between sellers of equity and buyers of equity, but that seemed particularly marked in the current environment. A couple of other things from the corporates was the costs of issuance. Those, particularly on the equity side, those were frequently talked about as a inhibitor for equity. And lastly, awareness. There's just not the depth of awareness of what's available from the private debt funds, from hybrid alternatives. And this is despite there are a number of hybrid instruments out there. There's an instrument popular in Switzerland and Germany called the Genuschein. Less popular now than it used to be in the past, but these are a form of instrument, a profit participating instrument that does not involve ceding control, but it does absorb losses before other debt financing. So the instruments do exist, but there is a lack of awareness on the corporate side. What about the investor side? So there's fragmentation across EU member states in terms of the different approaches to instruments and also insolvency and other aspects of financing. There's also concern about the kind of corporate governance of sort of smaller corporates and how to improve that to make to reassure investors, as well as tax incentives. And the last one that came out there in the news was some of the regulatory barriers that prevent institutional investment drifting and reallocated towards equity classes. Go to the next slide. So I'm just going to touch on what's available before Rick's going to talk about some of the solutions that we share in the report. Here's the list of both private sources on the left-hand side and public sources on the right. What you can see on the private sources is both equity and hybrid issuance. On the pure equity side, up in 2020 compared to the 2016 to 19 average. So there has been more public common equity issuance. On the private equity side, it was slow in H1, particularly post-COVID, but has been recovering in the second half of the year. venture capital levels were actually pretty, were less impacted by COVID. And then on the hybrid side, particular growth in convertible bonds. We have put in the profit participating shares and debt, but there's very little publicly available information on the actual volumes of those. Collectively, that adds up to around 150 billion euros in 2020. There's also plenty of public sources. I've already mentioned the EIB 25 billion of very targeted SME support. That's in particular schemes for quasi-equity or equity. Then at the bottom there, the broader support for Invest EU and Next Generation EU, which is broader business support. It could be loans, could be grants, but of course will alleviate the equity need. So that's what's available. But as we say, we think there is a gap compared to the overall need. I'm now going to hand over to Rick, who's going to take us through 8 recommendations coming out of the report.
Great. Thanks very much, Nick, for that very comprehensive overview. And we could turn to the next slide. The way AFME approached this was, in addition to working very actively with PwC's research with corporates, market participants, investors, and public sector officials, we also spoke with a number of different members who are active in restructuring corporates in a variety of different ways and in different industries, in different countries, and different sizes, and they all have different needs. But what we thought was important was in particular to put together a roadmap of how to address the solution. And based upon the feedback from PwC and our conversations with a variety of different members across geographic Europe, the first recommendation, which is by far the most important, is to try to develop a common recapitalization instrument that works for the corporate sector. As noted in the report, over the past few years, the banking sector has developed an instrument, a hybrid capital instrument called Additional Tier 1 Capital, AT1, which is something designed for banks. We need something that works for corporates. And I think the important analogy is that on the banking side of things, there was a very active cooperation between public and private sector market participants, and in particular, the different types of stakeholders who are involved with decisions about how to structure that type of hybrid instrument. In particular, each country, for example, on the accounting side of things, may have not only IFRS corporate reporting requirements, they also have local accounting requirements for exchange purposes, but as well as tax, legal, and other considerations. Our primary recommendation in this report is to try to get together the public and private sector to really address and put together a pan-European instrument that could develop scale, in particular, try to address the common structuring challenges that corporates will have, in addition to those that already are being developed by the market. As Nick mentioned, there already exist a number of hybrid instruments, particularly subordinated debt, payment in kind certificates, convertible bonds, and as Nick mentioned, in particular, profit participation certificates exist not only in Germany and Switzerland, but a variety of other countries across Europe. And they all have niche markets. They generally are sold privately, but there's models try to take the best of all those different instruments that have the common objective of not giving up control, not diluting, if possible, the voting rights of the corporate issuers. So that's our first and by far the most important recommendation, try to get the public and private sector together. The next objective is to scale up the existing EU and member state schemes. This is really important, and we're delighted to have the EIF with us today, who's right in the middle, in the heart of this process, and we're looking forward to the EIF's comments on their perspective. But one solution could simply scale up existing programs like the EIF's European Guarantee Fund, the Commission's InvestEU program, to really enable those to be made bigger, in addition to looking at developing a new private sector solution. I've already mentioned recommendation 3, which is the public-private working groups to work on the solutions together. There's a lot of expertise in different sectors, not only accounting, tax, legal, but also this needs to be pulled together to take the best of existing instruments which already exist. And we noted this is different than countries outside of the EU. Outside of the EU, these types of instruments are not as common. And we do think it's important, as this report notes, there's a couple of very good tables in this report which provide the details of these country-specific instruments, how they work in specific countries. They're sometimes in different forms. Sometimes they're equity, sometimes they're debt, sometimes they're in the form of bank type of instruments that are linked to the returns of the company, but don't give up voting control. That's a really important thing, is to try to look at the best practice across the EU 27. Fourth recommendation is to develop a public-private EU investment fund. This type of, we would call them vulnerable corporate, does require extra considerations. This isn't your typical private equity or venture capital investment. There's a different risk-return profile. In many cases, these companies are stable businesses which have been in existence for decades, but they need help to get through the COVID-related crisis. So we need to think creatively together with the buy side, in particular, on what instruments and which fund vehicles would make the most sense for this. If we can go to the next slide. Thank you. I've mentioned the need to look at different tax and regulatory incentives. There doesn't need to be harmonized tax treatment, but there does need to be participation by different member state governments involved with this type of roundtable we're looking for, to try to address things on a pan-European consistent approach that would be implemented on the tax side, of course, by the member states. A pan-European regulatory solution could be looked at as well. That's something that would require, I think, quite a bit more thought, but certainly doable. The information exists. Number 6 is to lower the cost of equity issuance for corporates. This is not a new issue, and we in the wholesale capital markets are one of the many different participants who arrange transactions for corporates of different sizes. There is no question that by the time you add up a variety of different fees for a transaction, whether it's underwriting or arrangement fees, lawyers, accountants, tax advice, listing advice, those types of things, it does add up. And we've proposed some solutions in the report to try to address this, whether it's, for example, using grants or subsidies from different member state programs to look at those expenses in return for example, a small amount of equity participation. Number 7, we think is also a really important aspect, is to look at state aid. It's a really important part of the whole investment and marketing and eligibility considerations. That's a really important thing to look at when designing this instrument, because having to review on a case-by-case basis state aid eligibility does slow down the process quite a bit in certain cases. So we think that's important to really focus on state aid rules and look at how that links into the Recovery and Resolution Fund solutions. And lastly, and again, we're delighted to have Tanya from the Commission here today. This challenge really underlines and highlights the importance of accelerating the implementation of CMU and banking union. We need solutions that cover corporates across the EU 27. This requires a variety of different considerations in terms of preparing offering documents, identifying investors, being able to distribute and market securities cross-border, how information is available to different types of investors, reporting requirements, and all those types of things. European single access point type of issues, all sorts of things, but this project underlines the importance of implementing CMU. And with that, I'd like to turn things back over to Pablo to begin the panel discussion.
Thank you very much, Rick and Nick, for that excellent overview of the report. It's fair to say you've provided a kind of summary of the highlights, but the report has a very rich content that I would welcome, people taking a look. There's a lot of analysis there, and Nick and Rick have, presented some of the main findings, but I would encourage everyone to take a look at the full report. Let's turn now to our panelists for today. We have a very distinguished set of discussants joining us. We're delighted to welcome Tanya Panova, the head of the Capital Markets Union unit at DG FISMA in the European Commission. Also very pleased to have Uli Hrabenwarter, who's the Deputy Director for Equity Investments at the European Investment Fund. In this capacity, he oversees the EIF's activities in impact investing, technology transfer, and venture capital. And he's very experienced in the venture capital and private equity space. We also have, very pleased to say, two members that participated in the AFME working group that developed this report. So I'm delighted to welcome Stefano Firpo, a Senior Director at Intesa Sanpaolo, who has extensive experience in banking and the financing of businesses in the Italian context. And also very pleased to have James Chu, Global Head of Regulatory Strategy at HSBC, who is also very experienced in SME and equity financing issues. He sits on the board of the Business Growth Fund and has been a member of the Commission's CMU High-Level Forum. So I will begin by giving them 3 to 5 minutes to kind of provide their reactions to the analysis in the report and their kind of opening views on the topic we're discussing today. And then we will go into some of the specific areas that we're looking at. Let me remind the audience that you can submit questions at any time, and we will be picking them up as we go along. So let me turn now to Tanya. Please, Tanya, give us your opening thoughts. Obviously, you've been thinking a lot about the implementation of the CMU action plan, and we welcome your initial reactions to the analysis we have submitted.
Absolutely. Good morning, everyone, or good afternoon, more like. Thank you very much for the opportunity to speak to you, to everyone today. And thank you very much for a very thorough analysis in your report. I think I will start my presentation maybe with acknowledgement that we agree on the diagnostics. I think we agree on the fact that there is insufficient equity, and recapitalization is one of the leitmotifs in the CMU action plan. So we need to build the investor base. We need to make sure that the regulatory around equity is adequate. We need to make sure that there are right vehicles to channel equity. We also need to make sure that companies want to issue equity, and this is a big problem today, as the presenters have mentioned. And dilution control is being mentioned as precisely one of the key reasons, at least for many family businesses in Europe, why they still do not consider equity as adequate source of financing. Now, on the report, perhaps very briefly, I think there are definitely suggestions which I would fully subscribe to, even without a further consideration. I think the need for the 3 layers to work together, so the national level, the EU level, and private sector level, on developing ways or ideas how to bring more equity and how to support more equity precisely in light of the problems, or the diagnostics, as I called it, I think is essential, because some things can be done at EU level, other things can only be done at national level, and other things require simply a change of mind and change in business practices, and there we do need support from the private sector. I think the exchanges of practices and knowing what exists is important. I think you did mention that there is a quite wide variety of available hybrid instruments, at least in some member states, but their use is still fairly suboptimal. There are many reasons to that. Some of it is precisely the fact that there is lack of awareness, and I think educating SMEs, educating mid-caps would go a long way in increasing the uptake of those hybrid instruments. The use of public support and the use of precisely the crisis support that has been announced and agreed at EU level is of course very important. I think we need to make sure that it goes and is channeled in the most efficient way. I think it wouldn't come as a surprise to anyone to say that a lot of burden or perhaps responsibility, that would be the right way of putting it, lies with the member states. There is a discussion currently as to whether this support needs to be subject to very strict conditions or multiple controls and safeguards. And we're talking about a big chunk of money, so obviously it needs to be controlled properly. But of course, the element of flexibility is something that many member states are raising. So how much we can determine and we should be influencing the way this support is being then channeled on the ground is of course a question to be raised. I think that the use of public-private funds and fund structures, vehicles, is something that I think can be very, very helpful. The problem is, and we might be talking about the AFME IPO fund at a later point, is of course that EU money comes with strings attached. So it comes with conditionality, and it comes with let's say, reduced possibility for private investors in certain cases to influence some decisions, because there would be an impact on governance. So the trade-off, if you wish, is in this specific case is how much scale, reputational benefit EU funding can bring, and how much in terms of reduced ability to influence investment decisions, but potentially in some cases it could bring along, and where this trade-off is really optimal, where's the middle ground to make sure that these vehicles really benefiting the development and of equity investment and supporting equity investment in companies. Tax and regulatory treatment. This is of course that goes to the heart of what we're trying to do. More on regulatory treatment, less on tax. Surprisingly, tax is a huge driver. It's a huge driver for anything, for retail investment, but also for companies and the way companies are using capital markets. And of course, we need member states to be more open to the use of tax incentives. But then, of course, it may tie in with the discussion on state aid. So as long as this schemes are open to everyone, there's no discriminatory element around it. Of course, the issue of state compliance is not raised, but the moment you start introducing, of course, some conditions, who can benefit, who cannot benefit, there we potentially might go into the area of state compatibility. And this is, of course, a very important discussion to be had. And this is where also the Commission, at least temporarily, relieved, I think, member states of I think, a number of conditions attached to the also assessment of compatibility, and allowed for some flexibility precisely because of the COVID situation. So I think we, as maybe just to summarize, I do agree on the diagnostics. I do agree with a number of suggestions in the paper, specifically on the hybrid instrument, and maybe with this I will end my presentation. I think this is a discussion to be held. I think personally that there are some considerations that need to be further researched, such as the bespoke nature of many of those instruments, and the fact that some of them serve very precise corporate finance needs of companies. And if we want to for this to be directed at SMEs in particular and some mid-caps, then those considerations are non-negligible, because of course the downside of a pan-European, Europe-wide solution is that it does introduce a certain degree of straitjacketing. In some cases, it might help to boost the market because it leads to standardization, of course, and brings with it scalability. In other cases, it can actually reduce the benefits attached, so to speak, to those instruments. But I think this is an important discussion, and I definitely welcome the work that has been done by AFME and PwC in looking into these questions, which are very important.
Thank you very much, Tanya, for that feedback. So I hope later in the session we will get into some of those considerations around hybrid instruments that you mentioned, because we want to cover those in a bit more detail in the panel. Let me now turn to Uli Hrabenborter. Please give us your initial kind of thoughts on the paper and how the EIF kind of is reacting at the moment to the current crisis.
Yes, thank you, Pablo, and good morning, good afternoon to everybody on this call. Thank you also for inviting me to participate in this discussion on a truly critical topic, and thank you also for the report that you have prepared in AFME to launch this discussion, and also to give us a kind of comprehensive collective overview of a problem on a pan-European basis and how we can tackle it. I think it is very important that we do take this holistic approach to discussing and debating solutions to what is an unprecedented impact of economic nature coming from this pandemic of COVID-19. And if we look at it, I think there's one opening statement that I would like to make in terms of praise for the awareness that we have had for the need for this type of action from the outset. I think this has been a very different situation in terms of responsiveness and reaction at the level of member states, but also at the level of the European Commission compared to previous crises where we had more confined topics to deal with and not this paramount impact on the entire economy, basically. Now, coming to the findings of the report, obviously I concur with the need to draw the attention to the massive impact that this crisis has had on the economic tissue of the European Union, and what it has had as an impact on the capitalization levels of corporates in all sectors and in all dimensions and sizes, and whether we are talking traditional industries or innovative technology companies and the like. It is something that has been striking the economy as a whole. What I find necessary and relevant in looking at the amounts that have been identified as loss of capital across the different sectors is when we look at measures to address those needs, that we are sufficiently sophisticated to be able to respond to the different funding needs that those companies have. Because the assessment that equity is missing as a result of the losses incurred during the pandemic and the economic lockdown that we have been experiencing, that would call for an easy solution and say, let us replace that equity and the companies are fine again. Well, we need to be aware that equity is a financial instrument, and especially if we look at it from the perspective of a private sector investor, it's something that is requiring return. And not all companies and not all sectors that actually have been hugely suffering from the economic crisis and from the impact of the economic lockdown do present growth perspectives, or even supposed to propose growth perspectives that would actually attract equity type of returns, would propose equity type of returns to private sector investors. And we also need to be aware that to a large extent that the equity erosion that has taken place over the last 12 months is something that potentially cannot be regained with economic activity alone. If you have basically a drop out of turnover for a big portion of a business year, it is not something that you're going to cure with just injecting an additional layer of equity from investors that are expecting a equity type of return from such an investment. It is rather something, and actually many member states have been having recourse to that, that you can cure by allowing companies to compensate for those losses, either through tax reliefs or through also compensation for lost turnover, as many member states actually had recourse to, in order to refill that gap of equity that has been created. Where financial instruments come in, and I think that is the point which the report very adequately addresses and targets in its recommendation, is when we are talking about industrial sectors and company situations where delaying the time frame in which this equity needs to be refilled can be helped with financial instruments. And there indeed instruments that are non-dilutive to capital and to equity ownership, and that actually serve for a given period of time as substitutes to outright equity, in anticipation that the core equity of the company is rebuilt with the profitability of subsequent years, is an instrument that can be hugely beneficial. And the other aspect that I would actually bring to the debate here, where we need to be as a kind of European continent, but also as policymakers, be very attentive to, is what is the impact on the growth potential and the equity base of companies that has been created by dislocation of funding in the context of responding to the financial crisis. In the private equity space and in the venture capital industry, we had a relatively sizable wave of fund managers and company owners preparing their companies in the portfolios to be able to hibernate for the next 12, 18, 24 months until we have good visibility that this economic crisis caused by a sanitary crisis is potentially ceasing and potentially be over. And in that period of creating the hibernation mode of those companies, what we are doing is basically we are in fund structures that had investment periods of 3, 4, 5 years ahead of them, anticipating the use of liquidity and cash in those funds in order to sustain companies that are currently in the portfolio. This necessarily comes at the expense of an alternative use of this capital in 2, 3 years down the road, and is creating a funding gap for potentially very critical sectors of the European economic policy, like innovation and technology, like transition to Green Deal relevant investment themes. That is a shortfall of capital that we need to anticipate in the response to the economic crisis that we are facing today. And I just wanted to bring that as a perspective to the table with respect to the response. I've got a couple of comments and observations to the very useful remarks that Tanya has been making, but maybe I will keep that to the debate that we're going to have amongst us, so that we get it more interactive. Thank you.
Thank you very much, Uli, for those observations, and look forward to hearing your comments later. And I will also ask you a bit more about the role that you see the private equity and venture capital industry playing in the recovery, but we'll come on to that. Let me turn now to our members. Stefano and James, you were both obviously involved in the preparation and the development of this report. So I'd welcome your kind of feedback on some of the highlights that you see from this this analysis. And also, I would like to hear from you in terms of what are your institutions, your banks, hearing from their clients, their corporate clients, in terms of their funding needs the next 2 years. Where are the gaps? What are the types of solutions they are seeking? I would welcome your feedback on that as well. Let's start with Stefano.
Okay, thank you very much for this opportunity to comment on such a major work, and I was very happy to participate in the effort that the group has put in developing such a report. I think that the report has many major merits. First and foremost, probably it focuses on the big issue, which is the recapitulation with equity-based solutions, and about the need for private money engagement in order to come up with solutions. So far, as we know and we reckon, we just bought time, basically. We provided liquidity via debt-based instruments, and we have been overburdening firms with broad access to general purpose rescue debt. But now what is needed is to address structural solvency issues and balance sheet restructuring, and try to make the market work again in reallocating resources. Another big merit of the report is not only that it provided a detailed sizing of the problem, but it also underlined the asymmetric feature of the problem. Because notwithstanding the symmetry of the pandemic crisis, which has hit all EU countries, equity needs, in fact, are very unevenly distributed. And they're particularly significant in smallest sized SMEs and in most firms who are in structurally challenged sectors such as hospitality, tourism, transportation, leisure, entertainment. And in these sectors, in these firms, is where access to equity investors and access to capital market is less likely to occur, naturally. The last feature of the report is that it calls for strong policy interventions. In policy intervention which should design first to attract private money, because so far we just poured huge amount of public money to the problem. We just throw big amount of money to the problem. And it also underlined the fact that the intervention should be concentrated exactly on these sectors and on those firms that need such a support. And so far, in my opinion, so for what I'm watching from my perspective, national and European instruments such as the mentioned InvestEU or the Pan-European Guarantee Fund seems largely insufficient and actually not very much useful in helping the recapitalization effort. They are mostly addressed to favor, once again, access to bank lending rather than augment the equity support. And so it is particularly important, the recommendation that the report is bringing forward. I think that Europe needs really to think about some sort of alternative way of financing, and hybrid instruments may represent a very useful tool. Actually, one of the big results of the report is that hybrid instruments are already representing a useful tool in front of the crisis. For example, in Italy, our National Promotion Bank is about to launch 40 billion euros program, which is called Patrimonio Destinato, to invest exactly in such instruments. And I'm sure that a common standardized European hybrid instrument is not panacea for sure, but it might be very helpful to create standardization and avoid fragmentation. Another thing that the report is actually underlining, which was not very much underlined during your summary, is that also what we need particularly if you want to target SMEs, we need aggregation platform. We should build a platform to create enough critical mass and providing diversification to attract investor interest in small tickets and unlisted firms. And in this respect, also securitization, for example, may be a useful tool. Securitization also of loan portfolios, which should be used to provide some sort of indirect capital market access to SMEs. And I think that a well-designed, some sort of originate and distribute model can provide significant opportunities for capital market access to SMEs, and also provide credit risk management tools to banks. One more comment is on fiscal incentives. Here, there is another, in my opinion, relevant aspect. We need more fiscal incentives to capitalization. So tax credit on new equity issuance, allowance for corporate equity, favorable capital gain taxation. But we need to target those fiscal incentives on those specific firms who need such an intervention. And this is the big conundrum between trying to come up with a selective policy measure against a design of state aid rules which doesn't allow very much selective measure or selective kind of interventions. Another aspect I would like to underline is the engagement of institutional investors, insurers, pension funds. I think we still face too many regulatory constraints to increase their equity exposure. And sometimes the industry, the pension fund industry, the insurance industry, sometimes even lack the scale and the skills sometimes for a proper equity allocation in their asset portfolio. This is particularly true for Italy, where we have a huge amount of savings coming from pensions or coming from insurance, but this saving is very badly allocated, and it can be very much allocated on equities and in particularly on SMEs because of critical mass and skills which are not sufficient and up to the point in the industry. So I'm very glad to have participated in the report. In the report, there are many suggestions, very rich in terms of suggestion, and I hope that such suggestion will be translated into actual policy intervention, starting from the Capital Market Union Action Plan, where we need to progress very soon. Thank you very much.
Thank you very much, Stefano. A lot of food for thought there. I think AFME members will be pleased to hear, in addition to equity, that you mentioned the role that securitization can play in the recovery. That's very important. Let me now turn to James, please, for his opening remarks.
Yeah, I think there's a few things that I'd like to add. I mean, obviously, when you go last, all the good comments have been taken by other people. The first thing I'd say is I think we've got to be careful of not seeing this as a single year program, which is an immediate response to the report. This has got to be a multi-year program of rebuilding the equity base. So we need to have a longer term perspective about this. And I think there's two things about equity which is important. It's going to speed the recovery. So if we waited, there will be a bunch of companies there will be companies who will have retained earnings, and gradually their equity base will come back and things will come back to normal. But we will have lost an enormous amount of GDP in that intervening period. So this equity injection is the thing that brings you back up to the normal trajectory of GDP. I think the second thing I would say about equity is we not only have a recovery problem, we're going to have an innovation issue. And the reason why I say that is there are a bunch of things from this crisis which will have changed. We know that the travel industry has changed. We know that ways of working have changed, etc. And we will need innovation as to how we approach that. And that means that new things are going to new things are going to need to evolve and be done, and equity is the way to innovate. You don't innovate on the back of debt, because debt is all about certainty of cash flows. You innovate with equity, and we're going to need a lot of innovation to drive this forward. I think as we talk about instruments, I think everybody's said horses for courses, as we say in the UK. So there are some companies in the growth economy who will take equity, and I think we need to build that capacity to deliver those equity, and that is something that we need to focus on. There's then a chunk of people for whom hybrids, as Stefano was saying, they will extend the time frame for them before, and that will allow them to rebuild their equity base from retained earnings. And then we've got to remember, there are a lot of companies who just don't like borrowing. I mean, 50% of companies in the UK don't borrow, and they will just take their time, and they'll have to come along at that pace. And we can't force this down people's throats. This is something that we've just got to recognise. But what we've got to do is try and find the instrument that will take people to the edge of their capacity to grow. And I think particularly if we can provide equity, I think that will enable companies with ambition and desire to go out and do the things that they might want to have done. That may be expanding market share, that may be taking over companies that have been difficulty and creating phoenixes out of those companies. But equity, if we can get pure equity out there, I think that will expand that. I think we do have a problem in equity at the moment, which is about expectations. I think investors are still very cautious about the world and the returns that they want to see. They haven't yet moved on a number of areas. I don't think they've yet moved on to recognize that long-term low interest rates are going to be the backdrop to this, and therefore they're going to have to look for yield elsewhere, and they're going to have to look for growth elsewhere. But the path of the pandemic still leaves a lot of uncertainty, and that means that they are, I think, still demanding relatively high returns at the same time as companies have not adapted possibly to those. So we've got a gap which has to be narrowed between what investors want and what companies are prepared to offer. And I think companies are reluctant to offer equity. It's partly emotional. I think if the companies who gave up equity in the past, they gave it up for two reasons. In a good scenario, they gave it up because they were growing, they were excited, they were ambitious, and therefore it was part of their plan. Or in a bad scenario, they gave it up because they performed badly and they needed to give it up in order to restructure and save the business. In both of those, the management had a rationale for giving it up. I think one of the problems here is, for some people, they were running a nice little company and doing okay and not doing anything wrong, and they just got hit by this juggernaut. And so emotionally, I think it becomes quite difficult for those individuals to give up equity when, as it were, it wasn't their ambition and it wasn't their fault. So I think that becomes a problem. I think that gap will narrow over time, and therefore I think the equity take-up will improve in the next coming years. One of the challenges we have is to be ready to provide that equity when those people come and ask for it next year or the year beyond. There is a very uneven distribution of equity investment capacity across Europe. There are some countries which have really good deep capacity. Actually, the Nordics do pretty well. The French do pretty well. Whereas if you look at other countries, particularly in Central and Eastern Europe, their capacity relative to what I would call the average investment capacity, looked at some data on this, is quite low. And I think we need to think of mechanisms to improve that operational capacity to execute. When we looked at this in the UK, we looked at what we thought was the number of transactions, that equity recapitalization transactions that would have to be done, versus the capacity to execute those transactions in terms of people and teams, etc. And there's a big gap. It is in some respects a ventilator problem. We've got more patients than we have ventilators. Maybe hybrids will be the instrument that carries us through until actually we can get around to those equities. I think there is also a big information issue about companies not being aware of what equity can offer, of having a disproportionate or a misunderstanding of what equity means. Private equity in some areas can have a bad name as being too controlling, too leveraged, too focused on exits. That's not necessarily the way that you need to make equity investments, and so I think we've got to spread that. I think one thing I am encouraged by is there's an awful lot of the issues that we're talking about information, about Solvency II, etc., which is in Tanya's bucket of CMU. Unfortunately, Tanya, you're in the spotlight. This has got to go as fast as possible. It's an absolutely crucial part of the equation. We've got to try and solve these things, and that is always a challenge to get that done. So all grist to your mill, as we would say. Just get out there and do it. I think the other thing that I would say is, even if we achieve those regulatory changes or we operate things outside of regulatory changes, there is an action problem. So people have ideas, but action is really difficult. You change regulation, but somebody actually has to do something with that scope that you've opened up. And that does mean, and it's action 3 in the AFME report, you do need to get these public-private partnerships together. You do need to get groups together to come in and create the new vehicles. And that, I mean, when we did BGF in the UK, that is very much a collective action by the banks to say, we need to put something into this gap. For us to do that individually is too big a strain, it's too difficult, it's not going to have sufficient scale. So we need to do it collectively. And I think if there's one thing that I would say comes out of this is collective action can deliver the scale that matters without the burden on individual firms or on individual investors, which makes life difficult. So I really think that's something that we need to look at, is how do you mobilize collective action to deliver the scale that we want? I'll leave it there.
Thank you very much, James, for those remarks, and again, a lot of food for thought there that we will be discussing shortly. I want to explore a bit more the kind of main recommendation of the report, which is the development of a EU-wide kind of hybrid instrument, in the form of a preferred share. And we thought of this solution because there are precedents. We have a precedent in the banking sector, the development of the AT1 framework for banks. That's there. Clearly, we're not suggesting that should be copy pasted for the non-financial corporates. We mentioned that as a kind of precedent. There may be features in the AT1 framework that are relevant to the non-financial corporate sector. Others will not be relevant. But we wanted to show that something has already been done. And I'd like to explore this a bit further, maybe starting this time with our members. Again, to not make you go last again, I'll start with you, James. From your perspective, what are the advantages you would see from the investor supply side of having a sort of a homogeneous EU-wide instrument with some kind of common features that can be labeled as a kind of crisis recovery hybrid instrument? If you're an investor, investing in a hybrid fund, do you think that level of commonality of EU-wide characteristics would be attractive? Would attract external investors?
I certainly think a degree of commonality helps. And look, I think if you're in a big country, you're going to have a reasonably deep market already, or the capacity for a reasonably deep market, and therefore for you, building scale which can be offered to investors is probably less problematic. I think if you're in a much smaller market, or it's going to be less attractive to companies in your particular market, being able to hitch your wagon to a broader caravan makes it much easier for people to begin to appreciate the product that you're selling. So to the extent that you can get features which are common, definitions which are common, nomenclature which is common, rates of return and target rates of return, which are sort of common. As you do these instruments, you'll impose conditionality on management. They won't be able to do certain things. The conditionality imposed on management is relatively common. It does make the due diligence by investors easier. I'll then go back and say, if it takes too long to achieve that, then national action is the way to go forward, because we have a time versus commonality issue. But the problem is if you're going down a mass market route, if you want to get a lot of investors in, those investors will want to build diversified portfolios across industries, across countries, etc. Then having instruments that are relatively common and fit within the guide rails of their investment criteria, I think that is an advantage. Scale is really important here. We've got a number of questions coming in, which is how do you deal with the scale? And the problem with dealing with scale is it's really difficult to deal with scale in a discriminating way. Therefore, you have to deal in a sort of cookie cutter approach, and that means trying to get some commonality in there. Whether I suspect it's going to be evolution rather than regulation that gets you there, that people evolve towards common standards, but discussions could get us there. Discussions could get us to a landing zone faster, I suspect, than a statutory approach would.
Thank you very much, James. Turning to Stefano now, I'd like to ask you also about, you spoke about the potential of such an instrument to bring scale and liquidity on an EU-wide basis. I'd like to ask you, to expand on that, and also to tell us a bit more about the Italian context. Clearly in Italy you have mini bonds, you have Italian savings shares. Do you think kind of a sort of EU hybrid instrument model could be attractive to the thousands of SMEs in Italy that are seeking financing? I think you're on mute, Stefano.
Here I am. Well, I think that in Italy, the instruments which have been allowed within the Italian system in terms of alternative way of financing from standard bank lending has increased a lot. So we have, as you mentioned, mini bonds, liberalization of mini bonds, we have credit funds, we have private debt funds, and now there is these huge initiatives to push at least from the supply side, hybrids like subordinated debt, convertible, and the like. And so Italy is betting a lot on this. There is this fund, is a 40 billion fund from our National Promotion Bank, which might change a little bit the scenario. The situation in Italy, also to turn back to your question, is pretty much polarized, let me tell. Because corporate needs are becoming more and more polarized, because the effects on the economy has been very asymmetric, I was mentioning before. So many firms in Italy are in very good shape, full of liquidity, also because they could access to guaranteed bank lending at very, very easy terms, and they just need more certainty to push investment. So there is just a big problem of the huge uncertainty which is still ongoing in the market scenario. But we have also many firms, many firms where there are a lot of jobs, particularly smaller size SME, all hit sectors, which have been really hit by the lockdown measures, and they are struggling. They have been piling up debt to cover revenue losses, and in the short term, for example, they're asking us, they ask the bank system to increase the maturity of existing debt in order to find a more sustainable financial position in servicing debt positions. But in the medium term, I'm sure that they all need to restructure the balance sheets and find new equity or equity-like forms of. And in this respect, as my previous chairman James was mentioning, in Italy we have a huge lack in the supply of equity, particularly because we lack institutional investors invest in such instruments, and so we need to find these bridge financial tools in order to open up the mentality also towards more open capital markets. And banks can play a role. Banks are already playing a role. We are using a lot, for example, securitization tools in order to provide SMEs indirect capital market access to capital markets. But I think that hybrids can really represent a useful tool. The problem with hybrids, and the problem even with a very standardized hybrid instrument, is that even though the instrument can be very much standardized, still insolvency procedures, bankruptcy laws, bankruptcy procedures are not equally distributed or evenly distributed in Europe. And this is a big problem. So even though we might come up with a homogeneous instrument, still the regulatory framework is too much fragmented to manage such instrument in Europe. And this go back to and nurture once again the fragmentation of the financial landscape.
Thank you very much for that, Stefano. I'd like to turn now to Uli. I mean, you have spent a lot of time in the equity space and reflecting on equity and hybrid instruments. And I would like to ask you, what potential do you see with this crisis for the development of such instruments, across the EU, in markets where they have been used, and also in other markets where they have not yet been used. And related to that, I mean, also wanted to ask you about the role of the private equity and venture capital sector. In the report, we talk about a degree of kind of dry powder being available from the private sector to support to provide equity, but clearly venture capital, private equity funds don't invest in all types of companies. They have their own mandates. There are companies that they will be interested in with high growth prospects, but there are others in sectors very affected by the crisis which will not be of interest to these types of investors. So I'd like to also ask you about the role that you see them playing in the next couple of years in the recovery. I believe you're on mute, Uli.
Apologies, the same trick always. Thank you, Pablo. And let me start maybe with the last question that you asked: what role can private equity and the venture capital industry play in this recapitalization process of the European Union? I think the main role that I see is a little bit in response to a couple of points that Tanya has been making in terms of implementing policy instruments, and the kind of worry that we need to have is where do we make the trade-off between getting the policy objective accomplished and making sure that it hits the policy objective and nothing else. And there's a question of eligibility of final beneficiaries that actually plays a specific role, but there's also a question of to what extent do we avoid state aid issues in being too granular in approaching specific sectors. I think there's one element that we need to be aware of when we look at a crisis like the one that we're currently in, is that from a policy perspective, you cannot be so surgical, precise, that you only target the companies that you would like to target and have a kind of very stringent catalog of criteria that actually determine which companies you want to address and which not. If you went for that type of if you went for that type of precision, you probably will lose that much in time of implementation of such an instrument that at the end of the road, you're missing the target altogether. So I think from a policy perspective, we need to be aware that we need some degree of braveness in bringing such an instrument to the market that will potentially also to some extent offset the law of Darwinism in the industry, and possibly save also companies that potentially didn't deserve to be saved, because no matter whether they were in the crisis or out of the crisis, they would have gone bankrupt anyways. So that's just one observation that I would like to make in terms of appealing to this open-mindedness that we need to have. The venture capital and private equity industry in that context can play a very significant role, because the selectivity of the venture and private equity industry has always been on the survival perspective of company and the growth perspective of companies, and hence this direction of policy support to companies that actually deserve the policy support could be addressed to some extent through that. When I look at it from the perspective of the instrument that you are suggesting, and I've said that in the introduction, I believe that a hybrid instrument that is kind of a silent partnership or a subordinated debt instrument that actually counts from an accounting perspective as a substitute to equity while having debt features, I think it is an important instrument for buying time for the companies to recover from the current situation and to gain time in replenishing their equity base. But I think it also needs to be seen in the context of a blend of instruments, because if we look at policy instruments that seek to provide additional capital to the European corporates and companies, we need to stay clear of the objective that we want the capital base of those companies to be refilled. It is not the main instrument to offer a attractive financial instrument to the investors. Because those are sometimes very different things to address. And if you look at that, there may be in some situations like bigger corporates that in normal circumstances have normal revenue streams that they can build on. That is a very interesting instrument for them, because they can buy time to rebuild their equity base. For smaller companies, it may be potentially better to provide them with tax releases or tax refunds or tax cancellation altogether, maybe paired with a condition that they are not allowed to pay out dividends for a given number of years, in order to allow them to actually absorb the own revenue generation from their companies in the equity base. So I think hybrid instruments are a very useful tool, and we need to definitely think whether funds specializing in this, especially for sectors that have no natural ownership, a change of ownership perspective in the business models, like technology companies, where you say, okay, you build them up over 4 or 5 years, and then there's an exit, there's a trade sale or an IPO or something like that. Companies that are family businesses for hundreds of years, companies that are in sectors like the hospitality businesses and the like, their hybrid instruments actually can buy valuable time for the companies to recover and to revive.
Thank you very much, Willie, for those. Yes, now it's me. Thank you very much for those observations. Let's keep our answers short so that we can take a few questions also that have come through. Let me now then turn to Tanya. I mean, same question to you, Tanya, on the potential you see in hybrid instruments. Clearly, you spend a lot of time in your commission role thinking about proportionality and subsidiarity, which are important EU principles. Sometimes having a harmonized framework at EU level can be very, very beneficial. Sometimes it doesn't work, and it's best to leave it to the member states who understand their market. So tell us a bit more what potential you see here to have some sort of recovery instrument at EU level.
Yes, indeed. This is a good question. I think we probably should start with asking, the question that matters. What is going to be the purpose of this instrument, and then trying to, what are we trying to achieve here, and then trying to see whether what we're proposing fits that objective. So, if the objective is really scalability, and indeed standardization could be one way to achieve scalability. We need to think also whether standardization could work in this specific case. And I think also in the context of corporate bonds, we've been spending a lot of time looking at possibilities to standardize a bit corporate bond issuances. To make sure that basically, there's more standardization and hence more liquidity, secondary market liquidity, because the lack of standardization or heterogeneity of corporate bonds we're seen as one of the obstacles to kind of more active trading. Only to conclude, after having spoken to a lot of corporates who've told us, we want an instrument that really fits our needs, and we want to be able to tailor make it and make it as bespoke as we would like. Because if you were telling us that we have to do it only in a certain way with a certain denomination, it's not going to work, because then it becomes less interesting for us. So the risk that we might be running here, and I see that one of the elements that are put on the table is also to try to go for smaller denominations. I guess in the hope of also making it more appealable to smaller size companies. The risk is that, of course, it might make it more attractive to some, but less attractive to others. And the downside of EU legislation in some cases is like it may act like a bull in a china shop, that it sort of with a big common objective tries to achieve a common goal, but then sort of on its way, neglects national specificities and company specificities. And I think Stefano has been talking about this. This crisis, even though it's been symmetric at the origin, it proved to be fairly asymmetric in a way it influences different member states and different sectors. So the question is, do we need a single instrument, hybrid instrument, that would address all of those specificities, all of those differences in one common way, and hence, try to hope that it would boost scalability of that instrument? Or shall we rather allow for this sort of, national specificity to rather be the guiding principle? So this is maybe one consideration. Another consideration for this instrument to really work, and this is my really off-the-cuff comment, I think we need to really try to align or harmonize or converge, whatever word you use, because it's politically sensitive, a number of really core legal principles. We need to align accounting treatment. We need to align tax treatment. We need to align insolvency treatment, because we're still talking about debt, which might turn into equity, or is debt that acts like equity, so to speak. So all of those issues, and in some cases, we need also to look into voting rights attached to those instruments, which is company law. So all of those areas, unsurprisingly, are also the areas that are extremely dear to the heart of the member states. How much progress can we make in aligning those principles to make it into a really, converging, really aligned treatment of that instrument across the 27 member states? It's a question. Of course, if there is a will, from the member state side to do this, and everyone agrees on the common objectives, I think everything can be done as long as there's a will, there's a way. If there is no will from the member states, this initiative, might be doomed from the starters. So I think what is important is to make sure that there is really a strong buy-in from the member state side, and there's an agreement to align those principles. Because in the worst case scenario, what we will end up is with a high-level minimum harmonization directive, which will create potentially more administrative burden, but would really not harmonize, not standardize anything. And then I think we would be counterproductive as a result. So this is something maybe as a general consideration, without necessarily pronouncing myself on whether or not we should be doing it.
Thank you very much, Tanya. Indeed, we're all subject to the will at the end of the member states and the European Parliament, the legislators, and it has happened that a crisis sometimes provides the momentum for the EU to move forward on common framework. So we don't know if this will be the case this time, but we will see how that debate evolves. I'd like to turn to some of the questions we have received. There are a few. I mean, I'll read a couple, and I'll let our panelists pick one of these in a minute or so to reply. There is a question about what do we do with micro-sized firms that are highly affected by the crisis and don't have easy access to capital markets. There's also a question here, have you spoken with bank regulators on how they would view swapping existing bank debt for a trans-European Genuschen type instrument? I think that's an interesting question as well. One from our chairman, Michael Colfontaine, asking how can we accelerate discussion of this report at the ECOFIN level and with the Portuguese presidency? Welcome your thoughts on that if you have them. So over to our panelists, who would like to go first on some of these questions?
Well, I'll just kick off on Michael's question, which is how do you accelerate discussion? Maybe it's something that we ask Eurofi to pick up. We will have there is the informal ECOFIN in Lisbon virtually. So maybe that's the time at which this is the sort of place that it could be discussed.
Thanks, James. Other takers?
Maybe I can address the micro company question. I think I did already to some extent in my previous intervention, where I said that it is important, and when we look at providing a solution to the broad spectrum of types of enterprises across the continent, we need to be aware of the differences of the funding needs that they have. And indeed, for microfinancing, but for micro companies or small type companies that have not yet this kind of track record of revenue streams over several years, or do have that but remain at a small scale type of businesses, we need to find ways to replenish their equity base by compensating them for the losses that they've made in the past. I don't think that there is any reasonable investment way that actually leads around this requirement.
Thank you.
Yeah, and I would agree with Uli on that. And I think the problem is just the logistical problem of dealing with that means that you're going to have a relatively indiscriminate amount of money, and that means an enormous amount of money. So the more you can be discriminating, the less money you lose, but the more difficult it is to execute. And the problem with these micro firms is you've got so many of them to do that is actually a real problem of having a discriminatory thing. In effect, in some cases, you're into helicopter money.
Thanks, James. We will need to wrap up very soon, but let me kind of in closing ask everyone a kind of a general question that you should answer very briefly. It's a point that Uli made around rebuilding the economic tissue. I mean, clearly we have a crisis, lots of businesses affected by it. We also have to progress a green transition and a digital transition in Europe, which remain core objectives. Are these two kind of forces in conflict? Supporting businesses that need to be supported in all sectors, and also driving the green transition. Are these two forces in tension? Are these objectives complementary? Should we be kind of prioritizing the support towards businesses at this stage, and kind of the green transition, leave it for a bit later. I'd welcome your thoughts on that.
Can I take a quick view on that? I think it's a very relevant question, and my short answer to that is that we cannot choose between the two. The urgency of rebuilding our economy doesn't come in layers of the Maslow pyramid, and we say that we deal first with the COVID crisis, and then we deal with the climate crisis, and afterwards we deal with another crisis. I think if we have to take that amount of money into our hands to actually bring our companies back to operating level, we also need to take the opportunity to redirect their business outlook to sustainability in the future.
Maybe I can come in right after Uli, because I fully agree. And I think, to be honest, this is an opportunity, because we're talking about a structural change for many of these companies. And, never waste a good crisis. I think, this is an opportunity also to restructure the business models of many of these companies. If equity comes with some conditionality around green, that might be a very strong incentive for some of these companies to actually rework their business models. And it might be even easy in a certain way. Of course, it's difficult. We all understand, companies struggling with lots of things at the same time. But sometimes it's best to do things that perhaps may hurt in the short term, but which may be hugely beneficial for everyone in the longer term. And this is an opportunity for us, an opportunity that companies might not be as open to the same type of transformation if we were to do it in a gradual way, taking many more.
Can I comment on that as well?
Briefly, yes, please.
Well, I agree that you have to try to do both things. But this is very easy to be said. It's not that easy to be done. I can really mention many areas and many sectors which have been really hit by the crisis and severely hit by the change in regulation in order to accelerate some sort of green transition. So I think that this is legitimate, obviously, but it requires a very careful balancing of the desire to direct change process against the need to avoid imposing excessive constraints on business which are struggling. So I agree in theory, but doing that in some specific sectors and some specific firms may create big contradictions. So you have to be pragmatic, I think, in this area, and try to do the best and find the best balance. But saying that there is no contradiction, I don't agree with that. There is some contradiction, and you should manage that.
Thank you, Stefan. I'm afraid we have to leave it there. A lot to discuss here, and I'm sure the points we've talked about will continue to be discussed in the next months and years, perhaps. Just a few closing words. First of all, I would like to thank warmly our panelists, Tanya, Uli, Stefano, and James, who have provided a lot of very good comments today. Thank you for the rich discussion. I'd like to take the opportunity also to acknowledge and thank the colleagues that worked in the report that we produced on the AFME side. April Day, Jacqueline Mills, Julian Allen Ellis, Mark Behrman, and Julio Suarez, among others. And our CEO, Adam Farkas, was also very intellectually involved in this work. So we thank him, and also our chairman, Michael Colfontaine, who has been very supportive towards AFME doing this research with PwC. Also, big thank you to the PwC team that worked very hard and long hours in developing the analysis. Thanks to Amanda Skellington, Matthew Nicol, Jing Teo, and Isabel Jenkins in particular. A big thank you also to the members of AFME's COVID-19 Corporate Impact Working Group that worked on the report, two of which we had on the panel today. And finally, our communications and marketing team at AFME for enabling this webinar and also helping with the distribution of the report. And last but not least, thanks to all our participants today. We're very pleased with the turnout we have seen. I would just like to say, please feel free to contact us separately with any further comments or questions on the report and what we have discussed today. At AFME, we're very keen to continue to promote the discussion on the subject among the public and the private sectors. To hear all types of comments on the solutions, the challenges, etc. We welcome any type of feedback, and our door is always open to all the interested parties. So on that note, I would like to thank everyone and wish you a good afternoon.